Hello everyone, today me and my friend gonna present you presentation. That presentation was prepared by Mikita Bazilev, Ibnu Aqil Mumtaz Akmal and Bilal Al-Khatef. Our company name is Origin Logistic Ltd. We have designed to establish a limited company because limited company are easier to open and it has file taxes. Partner is the limited corporation, has the same rights voice as their stakeholders. We wanted to focus on the local market, so we established this kind of business. Turkish commercial law sets a minimum capital requirement for one limited company. According to the law, the specific amount can change over time. So checking the latest regulations is important. The minimum capital required for opening limited company in Turkey was 500,000 liras. Stakeholders are Mikita Bazilev, 240,000 Turkish lira, Mumtaz Akmal, 300,000 Turkish lira, and Bilal Al-Khateb, 160,000 Turkish lira. Our aim is in this business is to take advantage of Turkey's strategic location for global trade by providing reliable logistics service as a growing demand in their sector offer long-term stability compared to other investments. Our main operation include cargo transaction, freight forwarding, warehousing service to support smooth and efficient supply chain management for our clients. In the near future, we plan to grow by expanding our capacity, adopting new technologies to improve operation using eco-friendly practices, and interesting our presence on major trade routes.
So coming to the balance sheet phase, we opened a company January 1st, 2025, and we borrowed 300,000 Turkish lira from DenizBank. As you know, on January the 1st, 2025, we have a million Turkish lira in cash for the assets and 300,000 Turkish lira in notes payable for liabilities and 700,000 Turkish lira in capital for equity, which makes it up a total of a million for the total liabilities and owner's equity. For the next stage, we have the debt ratio. As you know, total liabilities over total assets, which is 300,000 Turkish lira over 1 million Turkish lira equals to 0.3 or 30%, and debt ratio. That indicates a healthy balance as the company does not depend heavily on debt. It implies that the company is well positioned to manage its liabilities without being overly vulnerable to financial risks, which is surely a good sign. As for the transactions, the business opens with the initial investment of 700,000 Turkish lira for the owners and a loan of 300,000 Turkish lira on the January the 1st. On the January 2nd, we purchased the logistics equipment and credit for 50,000 lira. And for January 5th, we provided logistics services and billed the customer 25,000 in credit. And for January 10th, we paid the rent for office and warehouse space, 8,000 Turkish lira. On January 12th, we purchased fuel and supplies logistics operations and 2,000 Turkish lira and paid in cash. On January 15th, paid wages to employees for 12,000 Turkish lira. On January 18th, provided additional logistics services and accounting, earning 2,000 in revenue. And January 20th, received the payment of 20,000 Turkish lira from a customer for previous services provided. And for January 22nd, we paid loan interest of 3,000 Turkish lira. And January 25th, we paid the accounts payable for the logistics equipment purchased earlier, which is equal to 50,000 Turkish lira. Coming to the journal entries per transaction. So, January the 1st, as you can see, on account we have cash, capital, notes payable. So for cash we have 1 million debited and 700,000 Turkish lira in capital credited and 300,000 Turkish lira for notes payable credited. And January 2nd we have 50,000 Turkish lira for equipment debited and 50,000 for accounts payable credited as well. And for January the 5th, we have 25,000 for accounts receivable debited and 25,000 Turkish lira debited credited for their service revenue as well. And coming to the January term, we have 8,000 with rent expense debited and for the 8,000 credited for the cash as well. January 12th, fuel and supplies expenses debited of equal of 10,000 Turkish lira and cash and credited of 10,000 Turkish lira for cash as well. Coming to January 15th, for the wage expense, we have a debt equal of 12,000 Turkish lira and a credit of 12,000 Turkish lira for cash as well, the credited. And for date, January 18th, we have 30,000 Turkish lira for accounts receivable and debt, and 30,000 Turkish lira for credit and for service revenue. And for cash, we have for January 20th, we have 20,000 Turkish lira debited, and we have 20,000 Turkish lira for account receivable credited as well. And coming to January 22nd, for the interest expense and cash, we have 3,000 for interest expense debited and 3,000 Turkish lira for cash credited. And coming to January 25th, we have 50,000 for account payable debited and we have 50,000 Turkish lira as well in cash credited.
Okay, here it is, the ledger reports. The ledger report details the financial transaction in January based on the rules of debits and credit. Starting with assets, on January 1st, the company recorded a debit to cash for 1 million Turkish lira, consisting of 700 Turkish lira contributed by shareholders and 300 Turkish liras borrowed as a loan from Danish Bank. Since cash is an asset account, an increase is recorded as a debit. On January 2nd, the company purchased logistic equipment worth 50,000 Turkish lira on credit. This transaction was recorded as a debit to equipment for 50,000 Turkish lira, reflecting the increase in fixed assets, and a credit to account payable for 50,000 Turkish lira. On January 5th, the company provided logistic services to a customer, generating 25,000 Turkish lira in revenue. This was recorded as a debit to account receivable for 25,000 Turkish lira, representing the amount owed by the customer, and a credit to revenue for 25,000 Turkish lira to reflect the income earned. Similarly, on January 18th, additional services provided earned. On January 18th, additional service provided earned 30,000 Turkish lira. This was recorded as a debit to account receivable for 30,000 Turkish lira and a credit to revenue for 30,000 Turkish lira. On January 20, the company received a cash payment for 20,000 Turkish lira from a customer. This transaction was recorded as a debit to cash and 20,000 Turkish. This transaction was recorded as a debit to cash for 20,000 Turkish lira, increasing the cash balance, and a credit to account receivable for 20,000 Turkish lira, reducing the amount owed by customer. By the end of the month, the total assets included 937,000 Turkish lira in cash, 35,000 Turkish lira in account receivable, and 50,000 Turkish lira in equipment, which in total 1,022,000 Turkish lira for the asset. And for liabilities, the company recorded the 300,000 Turkish lira from loan from Danish Bank as a credit to loan payable on January 1st. On January 25th, the company paid off the 50,000 Turkish lira accounts payable for the logistic equipment. This was recorded as a debit to account payable for 50,000 Turkish lira, reducing the liability, and credit to cash for 50,000 Turkish lira, reducing the cash balance. And at the end of the January, the total liabilities amounted to 300,000 Turkish lira. And for the equity, the shareholders' initial contribution of 700,000 Turkish lira was recorded as a credit to capital. A revenue for the month of 55,000 Turkish lira recorded as a credit to revenue, while total expense of 33,000 Turkish lira was recorded as a debit. These expenses included 8,000 Turkish lira for rent on January 10, 10,000 Turkish lira for fuel and supply on January 12th, and 3,000 Turkish lira for loan interest on January 22nd. And after accounting all of these transactions, the equity by the end of January was 722,000 Turkish lira. And for this session, for an adjusted trial balance, let me explain a short explanation. An adjusted trial balance is a list of all accounts and their balance before any adjustments are made. It ensures that the total debits equal total credits, confirming the accuracy of double entry accounting system. This balance indicates that every transaction has been recorded correctly with equal debits and credits, maintaining the fundamental accounting equation. And this is our unadjusted trial balance, which consists of all the accounts I've mentioned before from the ledger stations. We have cash, accounts receivable, equipment, not payable, accounts payable, owners' capital, service revenue, rents expense, fuel and supplies expenses, wage expense, and interest expense. We have 937,000 debited to the cash, 35,000 debited to account receivable, and 50,000 Turkish lira debited to equipment. And when we move to the liabilities, we have notes payable and accounts payable. We have 300,000 Turkish lira credited to notes payable and 0 Turkish lira credited to accounts payable because we've paid all the accounts payable before. And then we have for the equity, we have owner's capital, service revenue, rents expense, fuel and supplies expenses, wage expense, and interest expense. We have 700,000 Turkish lira credited to owner's capital, service revenue, 55,000 Turkish lira credited to service revenue, and we have 8,000 Turkish lira debited to rent expenses, 10,000 Turkish lira debited to fuel and supplies expenses, 12,000 Turkish lira to wage expense, and 3,000 Turkish lira debited to the interest expense, which in total we have 1,055,000 Turkish lira debited and 1,055,000 Turkish lira credited. It's when we compare debit and credit, they are balanced, which means our unadjusted trial balance successfully record all the debit and credit, which means there is no mistake in calculation.